What's up, everybody? My name is Joe Brown. This is the Heresy Financial Show, and right now everybody is wondering how long inflation will continue. The Federal Reserve is trying to fight inflation by letting assets bleed off their balance sheet and by raising interest rates. And at the same time, many people are now afraid of the economy plunging into a recession as a result of that tightening, and a deep enough recession and depression would cause demand destruction, which could cause a deflationary event, deflationary death spiral potentially. So the question is, what is better? Inflation or deflation? If the Fed is truly in between a rock and a hard place where they have to choose between the purchasing power of the dollar or the economy, inflation or deflation, the question is, which one is better? Which one is the right path to choose? If you have to tip over one side or the other, which one should they choose? And if you stick around to the end, you will see that either way, whichever one they choose, the end result is typically always going to be the same. Ready? Let's dive in. All right, so we're going to look at a few drawings here. You know, if you've been around the channel for a long time, that I am a master artist. I am fantastic at drawing here. And so I'm going to draw some charts and graphs and lines and shapes for you because I know that's what you come here for. So we're going to look at inflation. Inflation is basically prices going up, just like that. Now, when prices go up, that's a result of the supply of money going up, just like that. And so when we have the supply of money go up, costs of goods and services go up because you don't have a corresponding increase in the supply of goods and services. So just like a teeter-totter where you have like a balance in the middle and then you've got something on top, if you've got downward pressure over here, that will push upwards over there. And so if you have an increase in the supply of money, if you have all of the goods on this side at this level, and then you have the money on this side at this level, it takes all the money to get all that stuff. So if what you do is if you get rid of or increase the supply of money on this side, so now you have it look like this, where your goods are down here and your money is up here, well, it still takes all the money to buy all that stuff. So you didn't increase the wealth, the amount of goods and services, you just increased the amount of money it took to get that stuff. So now we get to a point in the economy. Let's just draw a chart of the stock market. The stock market's been going up, and you get to a point where we had in 2020 where everything was about to head down. Now we're going to use this as the starting point in 2020 just because that's the most recent starting point. There were other things that caused this to go up that shouldn't have technically been happening, but we're going to look at just this point here at the beginning of 2020 and say that's the beginning. What should the policy response have been? So the policy response was to come in here, inject a bunch of money into the system to put a floor underneath the economy so that it would, instead of going down, it would head back up. Again, all the wealth stays the same. They didn't change the amount of wealth, but the prices will have to go up in response to more money entering the system because you have more money chasing the same amount of goods and services. It takes more money to get the same amount of stuff. So instead of prices continuing to fall past there, new money enters the system and prices go up instead. So the result of money printing, lowering rates, buying assets is inflation, is prices go up. Who benefits as a result of prices going up? Well, obviously, it's going to be the people that own those things. So if home prices go up, it's going to be the homeowners. If stock prices go up, it's going to be the people who own stocks. If the prices of private businesses go up because of new money entering the economy and new business ventures being able to be started because people are experimenting with different ways to try and make money, a lot of venture capital, things like that, companies going public, all the people who own all of the wealth benefit when prices go up. Who else benefits when prices go up? The other people who benefit when prices go up are the people who have debt. Why is that? Because when prices go up, incomes go up, right? Because when the price of labor, when the price of assets, when the price of goods go up, income goes up. You sell things for more. But the thing about debt is that debt stays the same unless you get more debt, but the dollar amount you owe is going to stay the same. So as prices go up, it actually makes that debt easier to pay off, because if you owe $100 and you borrowed $100 in order to buy something down here, but then it goes up to $200, well, you can sell that and pay off $100 and you still have $100 left over. And so both people who own assets and people who borrow are going to benefit from inflation. Now, if we take a look at the US government debt chart goes basically like that. They're at about $30 trillion right now. So does the US government benefit from inflation? Absolutely. If we look at tax revenue right now, tax revenue for the US government is doing the exact same thing. So that is an example of income going up from inflation for the US government. It makes it easier to pay that $30 trillion worth of debt. So the government benefits from inflation. So we see that inflation, printing money, stops prices from going down, benefits all the asset holders and benefits all the borrowers. If instead you have deflation where prices come down, let's say the Federal Reserve did not stop that, but let everything just crash. Well, who benefits? The people who benefit are the ones who are holding dollars. They're the savers, because when the price of something collapses, then they're going to take their money and use it to buy that stuff at the discount pricing, because when things get cheap, then suddenly they've got dollars that will go a lot farther than they did before. Remember the wealth example? You've got the wealth over here. You've got the money over here. And if the amount of money goes down compared to the amount of wealth in the system because there's deflation, then suddenly the total amount of money in the system is down here, but there's still the same amount of wealth. So it takes less money to buy the same amount of wealth. This is a little bit counterintuitive, but deflation results in prices going down because the amount of money total in the system shrinks. It's the opposite of inflation. Instead of there being more money available, there's less money available. This means there's less money available to allocate to prices, to buying things, and so prices of things must come down in order to compensate. So stuff gets cheaper. So the people who own the dollars instead of the assets win. It's the savers. Who else wins? It's the lenders, because if I have money and I loaned it to you and now you owe me back money, well then I loaned you money at a lower value than what you are going to pay me back at. Because when you come around and pay me back those dollars, if you remember, prices went down. So maybe before I had $1 worth of purchasing power and I could buy, let's say, one share of something at that. When deflation happens and the price of stuff starts to collapse, now that same $1 can be used to purchase 2 shares of whatever it was that I was looking at before. And so the ones who lend the money are the ones who benefit in deflation. So lenders and savers benefit from deflation. Now, who are the lenders? The banks. Who are the savers? Really nobody. There are very few people in America who are savers. The lenders are the banks, though. The lenders are also the savers, because when you save money, it's in a bank account and that money is lent out. It's used to lend out even more than that amount of money, but you get the point. When you're saving money, it's in an institution that uses that mechanism to loan it out. Same thing with cash in a brokerage account, same thing with cash in a pension, same thing with a certificate of deposit, a CD at a bank. Savers are lenders. And so when you have prices come down, those are the people who benefit, because prices come down, you can buy more of something afterwards. Whether it's house prices that come down, stock prices that come down, business prices that come down, the prices of goods and services. When you're a saver and stuff gets cheaper, you benefit. Now, the majority of Americans don't actually have assets. They have negative net worths when you consider their savings, their debt, their assets, their liabilities. They have a negative net worth. That means most Americans would benefit from prices coming down. So when we look at what happened in 2020, prices were going up and then everything was going to come down. There were going to be bankruptcies, companies were going to fail, you were going to have debt get defaulted on, things were going to get very cheap. Who would benefit here? It would be the poorest Americans. It would be the people who had savings. It would be the people who didn't have assets, because it would give them an opportunity to buy down here at the level they can afford instead of having prices stay up here at the level that they cannot afford. So that's how that would have happened if it would have just been a allowed to crash. We would have had deflation, and then assets would have been cheap and they would have been transferred. The ownership of those assets would have been transferred from the people who took too much risk and failed to the people who were very conservative and saved and waited for a smart opportunity to buy in. But instead, we got the bounce where the Fed put the floor in from prices and prices went up instead. So we got the inflation. But here's the end. Here's the tricky part that I wanted to show you. Right now, we had that bounce up and now everything is starting to collapse again. We are now starting to feel the same effects of deflation that we were going to get back there. We're feeling them right now. We are starting to have companies do layoffs. We are starting to have defaults on debt. We are starting to have savings. People are stopping spending. People are getting conservative. People are wondering where their paychecks are going to come from. People are not having income keep up with inflation. So what we're seeing here is that when you bail out the system, all you do is delay the inevitable. You're still going to get that same downward pressure that you were getting right here. But the worst part about this is that you had all the inflation in the meantime. And so as a policymaker, when you try and step in and stop the economic pain from happening, you can only do it temporarily. The result is prices go up and a lot of Americans suffer because now they can't afford the cost of living, because prices go up and their incomes didn't go up enough to compensate. But then you get the deflation on the other side where things will start to crash because all that deflation was supposed to happen anyway. Deflation is the natural force of history. As technology increases, as wealth increases, as progress happens, you get more wealth on earth. And so absent intervention, prices would go down over time. That's what abundance is. Abundance means it costs less to get something. If something is so abundant that it costs zero to get it, guess what? It's free. And as wealth increases on earth, that means more and more and more things that used to cost us a lot of time and labor to get, like food and clothing and shelter, end up taking less and less and less labor for us to get, so we can devote more and more of that labor and our time, our capital, and our resources to getting other things that we want because we get abundance. So deflation is the normal course of history where things get cheaper over time. But through intervention, you can cause temporary bursts of inflation. These temporary bursts might not look temporary. It might last somebody's whole lifetime, but they're still temporary in the long scheme of history, but you still get the deflation on the other side. So if you try and make the inflation happen, it's number one, it's destined for failure because you still get the crash, you still get the deleveraging, you still get the bankruptcies, you still get the defaults, you still get all the bad economic pain. But the downside is that you have the inflation in between where you hurt people even more. So we're experiencing all the same economic pain right now and going forward that we would have in 2020 if things would have just been allowed to collapse and the cards would have landed where they were. But because they decided to try and stop that from happening, you get a period of inflation, and then they realized, no, we actually have to let the deflation happen now, because if they don't let the deflation happen now, then you risk hyperinflation and losing the value of the currency 100%, a collapse of the currency. That's what happened in Weimar Germany. That's what's happened in Venezuela, in Argentina, in Zimbabwe, in Turkey, in Lebanon. Everywhere we've had hyperinflation, the central bank has looked at it and they said, hey, we stopped the deflation from happening. Now we have inflation. So we can either choose to now let the deflation happen now that it's coming back, or go all in on inflation and just destroy the currency in the process. Now, I don't think that's the choice that our policymakers are going to make, and at least that's not the choice they're making right now. But either way, when you look at what's worse, inflation or deflation, inflation is definitely worse, especially considering the fact that when you try and make inflation happen, you end up getting the deflation afterwards anyway. So you get both instead of just the one. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.